Now, if my inflation forecast is correct, and by the end of the year, we're at 6 to 9%, and it looks like this is sustained, the Fed will pivot. They will change their tune and they'll start tightening up. And when they do start tightening up, we'll see the multiples in the stock market come down, and the stock market, there will be a correction in the stock market. But until then, it's relatively clear sailing.
Thanks for joining us for part 2 of our interview with economist and currency expert Steve Hanke. If you haven't yet watched part 1 of our discussion with Steve, in which he explains why he sees inflation not abating, but rising even higher from here, eventually hitting a painful height of up to 9% by the end of 2021, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Steve and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to support this channel by first liking this video and then clicking the red subscribe button below, as well as that tiny little bell icon right next to it. These 2 tiny costless steps only take you a few seconds, and they really do help us out, because when you take them, YouTube will share this video more, reaching more people and helping us attract more big name guests to come on this program in the future. Okay, now that you've liked and subscribed, let's get started watching part 2 of our interview with highly respected economist Steve Hanke. A couple questions for you, but first is, as you look forward to sort of the markets, what's your best guess here? Do you see them just continuing to go higher as the inflation you see coming, continues to go out there, or do you see inflation beginning to bite into margins? And we didn't really talk about this, but almost any financial asset price at this point in time is at a record high level of valuation compared to historic metrics. So I guess my question is do you see sort of an eternal melt up here, or do you see a risk that there could be some sort of, at least asset price wise, deflationary insult here where there's a big correction?
Well, it depends on when the Federal Reserve pivots and starts tightening up. Now, if my inflation forecast is correct, and by the end of the year we're at 6 to 9%, and it looks like this is sustained, the Fed will pivot. They will change their tune and they'll start tightening up. And when they do start tightening up, we'll see the multiples in the stock market come down, and the stock market, there will be a correction in the stock market. But until then, it's relatively clear sailing. I mean, you want some exposure. The question is, well, what do you get exposed to? Well, you could just buy an index until you make a guess, a forecast about when the Fed's going to pivot. Because once they start pivoting and the market starts anticipating that they are pivoting, the market will come off. So that's in general. As far as the sector, I already mentioned home builders. There's a big backlog. Home builders are a good place to be. And as far as inflation goes, if you think my forecast of sustained inflation is going to be with us for a few years, you want to be along some commodity index. I think gold miners are probably fine. Inflation protected securities, what they call TIPS, those are good for more conservative play, but that's how to protect yourself, because those treasury bonds are protected, adjusted for changes in inflation. And if you're again, I want to have a little long position in crude oil. Probably crude oil prices are staying up. All the commodity prices are going to stay up. The grains, we got grains at record levels, but the best place for average people that aren't, and they don't have access to commodity specialists or anything, you just get one of the good commodity indexes.
All right, that's great. And what I love about two things you said, Steve, is we have a lot of experts on this program week after week, and I love it when the majority of them, who all have different approaches, different techniques, different forms of analysis, et cetera, when they seem to be kind of converging on a similar viewpoint, it just gives me a little bit more confidence that because people are coming at it from different disciplines, if they're coming to similar conclusions, their conclusions are more likely to be probably right. And what's interesting is we're a lot of people we talk to give a sort of a similar set of places to invest in to protect yourself against inflation. So thank you for being that specific, though. If I got you right, and I know none of this is personal financial advice, and folks should talk to a financial advisor before taking any steps, but you're saying that hard assets should do pretty well. You like the commodity complex, you like oil, you like gold miners. You think home builders, for the reasons we talk about, is a good sector. Tips, natural way to sort of protect against at least reported inflation. But another thing you said that I just want to take a second on is we've had a couple guests of late kind of crystallize for us a progression they see, which is a period of disinflation where basically the status quo is going to continue for the rest of the year, but the rate of inflation might start beginning to slow a little bit over time. Maybe in your case it might actually speed up. Who knows? But some period of time still, maybe measured in months, where prices are going to continue their upward trajectory. Then at some point, maybe in 2022, maybe sooner, maybe later, there's going to be some correction in the markets. And then there's going to be a policy response to that is going to be highly inflationary. So I heard you mention parts 1 and 2. Do you also believe that after some sort of market correction, we will see more liquidity being ushered again in response to trying to goose things again? I don't want to put words in your mouth, which is why I'm asking you here.
It's a little bit hard to say because you got a number of things that you'd have to be looking at. If the real economy starts slowing down and you sinking, and we don't have the 6% kind of number we're talking about for this year, and the labor market starts getting flabby and so forth, then those would be the conditions that they would goose it again.
Right. So, like, in other words, like companies starting to shut down, that type of thing.
Well, let's put it the scenario like this way. Now they're goosing everything, okay, and even now they're talking about maybe pivoting a little bit. They're going to be slow in doing that because the Chairman Powell of the Federal Reserve's up for reappointment this year. And he wants to be reappointed, and even the progressives don't think he's goosing things enough. So he's going to want to keep the pedal to the metal as long as he possibly can. Even if that's why he does all this temporary inflation talk. He says, "I don't worry about it. It's just temporary. It's going to go away." Well, what if it doesn't go away? Eventually, they will start tightening the screws. That will happen. That piece of the pivot we know, that first pivot, and then the markets will come off. Now let's assume that not only the markets come off, but the economy really starts slowing down and the labor market gets a little bit flabby. Then we will get another pivot, and that pivot will be one of goosing things again, especially if the Biden administration is in there. There's a huge bias, as you've obviously observed, to goose everything under the sun with Biden.
Goose to the moon.
He's just got blinders on. So it is possible, but I think you'd have to get a much weaker economy and much weaker labor market to go along with the disruptions in the financial market that will occur as they tighten up. I wouldn't say disruptions. That's a little bit of a strong word. There'll be adjustments. The markets will adjust. The high multiples that we're seeing in the stock market will come down. Now, Now, if those financial markets are disruptive, then maybe the Fed's pivot. They'll do what they did the last time the financial markets got themselves riled up. They pivoted again and they loosened up. They were afraid, the Fed, and loosened up. So it's really difficult to say, to make a forecast. All you can do is talk about different scenarios, what might happen. The only thing I know and feel confident about, more inflation. Eventually, the Fed will have to throw in the towel and say, Hanke, you're right. This wasn't temporary. Milton Friedman and Hanke were right. The inflation is always and everywhere a monetary phenomenon, and we're part of the problem. So we got to pivot and we have to tighten up. And when that happens, there will be adjustments in the stock market. There's no question about it.
All right. Well, thank you. And yeah, sorry to push you to prognosticate on things that are several stages down the road. Hopefully, before we're closer to there, we'll have you back on this program and you can tell us what you're seeing at that point in time.
Yeah, that'd be great.
Great. Well, look, as we wrap up here, a couple quick questions for you. One, you mentioned briefly, we've been talking about inflation. You mentioned briefly that you liked the gold miners. We talk a fair amount about gold in this program for the obvious reasons. You know, it's sort of a natural protection against currency debasement. And you actually have a, sorry, I have to look at my notes here, but you actually have an index that you've put together. Can you just very quickly explain what that index measures and what it's telling us right now?
Yes, this is something new, and it's kind of in a pilot project stage, almost really ready to be coming online. And here's what it is: it's called the Hanke-Kaufness Gold Sentiment Index. And what we do, we're able to observe on an hourly basis all the articles coming and blogs coming out about gold. And through what they call text mining, Adam, we can determine whether the article is bearish or bullish. So we know the frequency of the articles, how frequently they're coming out, and we know whether they're bullish or bearish. Right now, that index, it's in what we call kind of a neutral zone, slightly, it's still neutral, but slightly on the bearish side. So the fundamentals of gold I like, because inflation is good for gold. But as far as timing right now, I want to just keep my powder dry and wait until that index, which we are really calibrating every hour, until that thing tips further into a bullish mode. Right now, it's in kind of a neutral, semi-bearish mode, but you have to keep watching the sentiment index, and we will be public with this, I think, within 2 or 3 weeks. So when that happens, this thing will be available free for people, and they will be able to put it on their iPhone and look at the temperature in the market, the Hanke-Kaufness gold sentiment thing. Just pick up your iPhone and hit the app, and oh yeah, the thing has just gone bullish, I'm buying, or it's gone bearish, I'm selling, or it's just neutral like it is now. I'm not really doing anything. If I have a position, I'm keeping it. The fundamentals are strong. So that's a very exciting thing, because no one has been able to measure sentiment in this way before through text mining.
Well, this sounds like a fascinating new resource. So when it does go public, it sounds like there'll be an app for it. Will there be a website for it as well?
Yes, yeah, there will be a website, and there'll be an app, and it will be free. Maybe I can be in contact with you when it does go public.
I was going to say, great, yeah. When it does, just send it to me, and I'll let everybody know.
I'll give you a ring, so your viewers will be able to go to the website and sign up free, get the app and so on, and follow it, and make their own judgment about whether they should be buying or selling at any particular time, given where the Hanke-Kaufman's goal sentiment happens to be. They can analyze the thing themselves and figure it out whether they think it's a leading indicator. So far, it's been very accurate, by the way. All the big moves in the gold market we have so far, knock on wood, we've anticipated them with this Hanke-Kaufman's gold sentiment index.
Ooh.
But as I say, it's still pilot stage, but very close to launch.
All right. Well, look, there's going to be a ton of people, I think, interested, especially that you just gave a nod to the fact that it may actually be a predictive indicator here. So, folks, if you're excited about this and would like me to get the information from Steve when this launches and share it with everybody here, just let us know in the comments below. But I'm going to proceed assuming that there's strong interest for this. Steve, one last question for you. Just because I pulled people on Twitter, what questions they'd like me to ask you. I think I got through most of them, but one I haven't asked about yet is cryptocurrencies. And I know we probably don't have enough time to really do your answer justice, but I guess two questions for you. What is your general outlook on them? And what do you think is the potential for CBDCs, central bank digital currencies, coming into the wild in the next couple of years?
I think I classify myself as a crypto skeptic. I tend to be critical of a lot of what I see in the crypto community because a lot of it is just economic nonsense, quite frankly. So in that sense, if nonsense comes out, I criticize what I think is a nonsense. So that's one aspect of, and in particular with Bitcoin. Bitcoin being the one that I've had more critical things to say about. So that's one aspect.
Hey, Stephen, I'm sorry to interrupt you, but just real quick, when you talk about your skepticism, if you can, do you make any distinction between the claims as a competing currency versus a store of value? And I ask this because I think a lot of people who've been following cryptos, they've almost kind of given up on them, and Bitcoin included, on becoming an actual competing currency. And the argument still tends to fall now more on the store of value.
Well, I think it's no. I think they are speculative assets. If you have a high tolerance for risk and you like to speculate, if you like to go to Vegas, it's fine. I would never counsel not to be speculating if, in fact, you had a very high risk tolerance and you like to speculate. I mean,
and you could afford the losses.
Yeah, if you can afford the losses, that's fine. I mean, or in the last, it was down. Bitcoin was down, under 31,000. A couple of weeks ago, and now I haven't looked today, but it's zoomed up, and it's so if you would have bought down at the lows a couple of weeks ago, you would have had a handsome profit, but that profit could disappear because I think the fundamental value of Bitcoin is zero. So I think eventually Bitcoin will go to zero, and people say, well, why do you say that? And I say it because there'll be superior competing cryptos that come along and push Bitcoin to the side. And since its fundamental value is zero, in my opinion, it will go to zero. Now, the second question you ask is something it's related, but it's quite different. And that is digital currencies, or what Milton Friedman actually identified this many years before the word digital currency even, right? He called it the electronic money. And digital or electronic money will come, and unfortunately, I think it's going to rob us of a lot of freedom, because it will mean Big Brother will be able to tell exactly every transaction you ever make, down to the last penny. So if you thought George Orwell was extreme, you got another thing coming, because once we go cashless, if we have a cashless society, the government will be able to tell everything that you're doing, everything. Now that's one thing that most people haven't really gotten through their head, but that's what's going to happen. So again, it's more of this intrusion of big government on privacy and private lives and liberties. That's where we're going with the cashless, so-called cashless society.
All right, and I mean, it's depressing to hear that we've talked about some of the concerns you just mentioned on this program before. You know, the government knowing exactly where every dollar is, who holds it, what they're spending it on. You know, perhaps when tax times comes around, you don't even need to file; they're just going to automatically, tax your holdings.
Oh, they'll be able to file for you.
Right. Or if they suspect you of doing something you don't like, they can just freeze your assets, right? There's nothing you can do about it. So I guess my question for you, and I think I know the answer to this, but is, do you see them as inevitable?
Yes.
Okay. All right. Well, look, I would love to dig further into that with you, Steve, but I think we're going to have to leave that for next time. I've taken up way more of your time than initially planned. Thank you for being so generous and delivering such a thoughtful interview here. For folks who have really enjoyed your commentary and would like to follow you in your work, where should they go?
Well, they can, number one, they actually can write me at hanke@jhu.edu or follow me on Twitter. Following me on Twitter is the best real time. You can give them my Twitter handle and they can tune in on that. I think I'm ranked as the sixth most influential economist in the world because of the Twitter. I'm number six. So it's
number six on Twitter, number one in our hearts, Steve.
Yeah, exactly. So we won't mention the five up ahead of me, but there's some that have huge following and huge influence too. So that's one thing. The other thing is the Cato Institute website. They have just plug me in. I'm a senior fellow there, and they have an archive of many articles and books that I've written. That's probably the best thing. Or
all right, great.
Another website would be the Johns Hopkins Institute for Applied Economics, Global Health, and the Study of Business Enterprise, which I founded and I'm a co-director of. That also has lots of material. So either the Cato or the Johns Hopkins sites, or send me an email, or the real time good thing to do is a Twitter.
All right, great. Well, we'll put the Twitter handle up as an overlay when we edit this, Steve. All right, Steve. Well, look, again, I cannot thank you so much for giving us so much time, focus, and attention here. It's been a wonderful discussion, and I really hope we can bring you back on the program later on this fall.
Well, I'm looking forward to that, Adam. Thanks so much for having me.
Our pleasure, Steve. Thank you.
Yeah, see you.
All right. As we do every week, I'm now going to talk with the lead partners of New Harbor Financial about what the markets have been up to. John and Mike, great to see you guys. Another great interview there with Steve Hanke. I think he sees the world quite similarly to the way that you guys and I do. Seems like he sees potential for the market to maybe still continue climbing higher for a little bit, but then eventually this sharply rising inflation, especially if it gets up to his 9% prediction by the end of the year, is really going to start biting into margins. And John, as you've said on the program many times before, the beginning of a new inflationary era is actually a really bad time for stocks. They underperform in that type of environment. Is that correct?
Yeah, it is, Adam. And I think Steve gave a very thoughtful interview there. He obviously has quite a bit of background in economics and understands the whole mechanism of inflation. And he called up the famous quote there of inflation is always and everywhere a monetary phenomenon. And yeah, that's why he sees, with the massive amount of money supply expansion, he sees inflation ticking up considerably. And absolutely, if you go back and look at history and plot out actual subsequent returns based upon inflationary environments, Periods that start with very high valuations like we have today, never been higher. That's a fact. It's not subject to debate. Have been horribly, bad periods for investors to be in stocks, because the very first casualty, or one of the very first casualties of inflation, beyond higher prices at the grocery store and housing and stuff like that, is that stock valuations plummet. They get knocked down to what might be considered more value levels, and it's only after that do stocks, rightfully deserve their reputation for being a good inflation hedge.
All right, well, let's talk about sentiment for a second. So I want to bring up a chart here of the University of Michigan's Index of Consumer Sentiment. So this sentiment chart is a chart of the University of Michigan Index of Consumer Sentiment. It's a monthly survey that's run, and we can see here that it's taken one of the largest drops ever over the past 10 years. This is largely driven by the fast rising number of cases in the COVID Delta variant that we're seeing across the country, but it also takes into account probably likely the rising consumer prices that this inflation is causing, as well as people's worry about the approaching expiration of the rental eviction moratorium, and the foreclosure moratorium ended at the end of July. So there's a lot of reasons for people to start to get worried here. This does not reflect, we should say, this was all recorded before the recent ignominious pullout in Afghanistan, which I think is also going to be weighing on consumer sentiment as well. So, gents, here we've got a decrease in consumer confidence, which very well maybe could be an indicator that folks are going to want to be a little bit more conservative with their investments. Are you guys seeing this as a potential harbinger to people maybe pulling some of their money, some of their gains off of the stock market? Mike, what do you think?
To be honest, Adam, we try not to read too much into short-term changes to indicators like that. The truth is that consumer sentiment has been pinned in a very extreme fashion to the upside for many years now, and that has been in existence alongside with ridiculously overvalued, at least compared to historical readings, valuations. Valuations still remain extremely overvalued. So yeah, it's not a surprise that sentiment is down, at least over the last couple of months, as Delta variant starts to increase and gain a foothold. But little has really been done to valuations. The NASDAQ is sitting right near its all-time high, and valuations are extreme, to say the least, and they're extreme in ways that actually mean something to what the S&P 500 or the broad stock market does over a period of time, like a period of 8, 10, or 12 or 15 years. We're seeing even just the straight plain vanilla Shiller price earnings ratio is in the high 30s, and there's some. You could say that there's some other valuations that might be even better for predicting future return, like the Buffett indicator, stock market cap to GDP, that kind of thing, which is well over 200%, a level that's never been seen before here in the US. So we're concerned that type of indicator might be a little bit whippy. Some might say it's bullish as a contrarian standpoint. We don't see how that could be when we're still sitting at all-time highs in the market with these valuations. Sure, something is going to get people to start selling. So, maybe the quick drop in consumer sentiment is the catalyst. It's really not worth it to try to figure out what exactly will be the catalyst. We remain extremely concerned based on not only valuations, but leadership in this market. Only a couple names are really doing very well, and everything else is kind of rolled over. We take a look at the Dow. The Dow here is below levels that were, we saw back in May 10th. And 3 months later, the Dow was lower. I know it feels like this market is relentlessly going up, but it's only a couple stocks. So we would consider, again, that the sentiment indicator to be something that's probably more noise than not.
Okay. And that's a great point about the Dow. As we've talked about in past videos here, the concentration that we're seeing in terms of the stocks that are actually driving the increase in the major market indices these days. As you said, Mike, it's getting into fewer and fewer and fewer stocks. And that's obviously why the Dow shows this more than the other indices, because some of those stocks are not in the Dow index, but it's largely the big tech, the I don't even know how to pronounce it anymore. The FAME stocks, Facebook, Alphabet, Amazon, Microsoft, Google. I think I said Alphabet, I meant Apple. But anyways, that is a classic late stage sign of a market that is running out of steam when it's fewer and fewer and fewer stocks that are pulling it higher. So I'm glad you pointed that out. All right, so just in wrapping up here, guys, so let's talk about gold for a second, because Steve, like many of our other guests, and I love it when people from different disciplines come to the same conclusions, Steve thinks that gold is actually a good place to be putting capital right now. What's been happening in the gold market recently? I know, we talked a lot last week about the flash crash. What's going on with it now?
I'll take a shot at that.
Go ahead, John.
I'll take a shot at that. Yeah, it's been weak of late. No doubt about it. We are very constructive for gold longer term, and certainly in inflationary scenarios should be supportive of that. But near-term moves are definitely sentiment-driven in gold, I think. And to Mike's point, it's really important, we think, to kind of not get overly focused on short-term sentiment and short-term moves here, because you can oftentimes miss the bigger picture. And while we certainly see the bigger picture, for example, stocks being vastly overvalued, nothing in that, in our minds, is are we saying that they can't go higher in the short term? That absolutely could happen, and maybe will, but it doesn't change, I think, the ultimate outcome. Same with gold. The recent weakness we don't think is emblematic of anything fundamentally amiss there. In fact, the fundamental case is every bit as strong as we think has been in a long time. There are some short-term sentiment and technical factors that are weighing on things. The dollar's been strengthening, so that oftentimes, that's usually a very tight inverse relationship. The dollar is reaching some kind of overhead resistance where it is now, that we might see that start to stall out. And we do have some hedges in place on gold mining positions that we have for clients, larger accounts that can enable use of options that we use to hedge. So we're not blindly bullish on gold. It just simply checks a lot of the boxes that we think fundamentally make it a good place to be.
All right, thanks. And just on that, I was talking with one of the many gold experts that I talk to frequently, and they were reminding me, just like I think you guys are saying with your general market positioning, there may be, there might be a last gasp higher this market to try to, again, we use the term collecting nickels in front of the steamroller, that folks could potentially play for, but the downside risks are so much higher that they don't justify taking on the risk of going after pennies and nickels at this point in time, and that market corrections tend to be catch people by surprise and tend to be severe, and we just learned this in spades last year with the collapse at the end of February, and it's the same thing with the precious metals. Is when that market turns, it usually catches people by surprise, and then premiums skyrocket, and then also inventory disappears, which we also saw last year. So, it's the kind of thing where you need to be in it before the event that you're investing for takes place. And, I'm sure, some people who have been, in it for a while might be frustrated by the weakness you mentioned. I would kind of call it softness. Gold is still, not that far from 1800. I mean, these are really attractive prices, particularly at the miners. The miners, as we've talked about in past shows, are very favorably profitable at gold prices like these. And I think, Mike, you talked last week about how, we had the flash crash in gold a week and a half ago, but gold has made up all of that and then gained some, which is a very, promising sign of strength that even when the big players try to monkey hammer it, it's not staying down the way that it used to in past years. So, all right, guys, well, look, as we wrap up, I know that you are getting lots of calls from folks, both, excited to put their money with you, and also folks that are, saying, hey, we're all in on the outlook you guys have. the fact that almost everybody we've talked to has said, look, at some point we're coming up on a reckoning here where the market's going to drop pretty quickly. But when, dear God, when is it going to happen? Any parting words to share with those folks, guys?
People are really fatigued. I mean, heck, we're fatigued too, right? You know, this set of extreme conditions have lasted a long time. It's not different this time. We have viewed almost a wholesale capitulation amongst the people that we talk to that it might be different this time. You know, even we will admit that it has been different this time in that it's been more extreme and lasted longer than ever before. But math has never been wrong before in history. And I know that many will say, well, yes, but we've never had money printing like this before. I guess that's true too. I mean, history is never exact. It rhymes, they say. But it is, you know, a moment of faith to believe that math and fundamentals and data matter. And that is what we continue to believe and what we're acting on. We do not think this time is different or will not be different ultimately. And you know, we're humble enough to know that we don't know the exact timing of the turn, which is why we remain positioned like we are. And we will continue doing that.
Great. And John, look, I'll let you have the last word, but just to build off of Mike's point there, you know, one of the really important things that Steve got across in this interview was, you know, really the only thing that our central planners know how to do is to lean in and is to intervene, is to inflate. And that works great initially. You know, he went through that three-part, those three phases. First, you see asset prices shoot the moon, right? And that's what we've seen since all of this extraordinary stimulus started in the middle of last year. We've had that phase. Then, you know, after a delay, you begin to see the economy begin to pick up, which we've seen starting, you know, end of last year, beginning of this year. But then all of that liquidity, all that intervention then sets off a chain reaction where inflation starts running higher and higher. And that starts biting into margins and raising the cost of living. And then everybody that doesn't, you know, have access to financial assets, you know, they begin dropping below the waterline. And in Steve's words, he said, in that phase three, inflation takes back all of the gains of the previous two phases. And so for those that are, you know, getting fatigued, like Mike said, just be aware that this is a process that has played out many times in history. And we are now in that phase three, right? We've got already, I think Steve said, around 6% inflation, now heading to 9% in his estimation. That can't sustain for very long, folks. That is going to bring down margins. That is going to start breaking households. It's going to apply a lot of pressure on the Fed and the administration to not continue the extreme liquidity intervention in the short term. So as Mike said, you know, at the end of the day, folks, it's all about math. John, any parting words here?
Yeah, no, I mean, Steve did hit the nail on the head. You know, the policies that come out of the Fed and central banks that are in their brethren, they follow the same script time and time again, and it plays out reliably the same way every time. Boom, bust, boom, bust. In fact, you know, I think it couldn't be better said than a quote actually from one of the Fed governors or Federal Reserve Chair back in a documentary maybe 10 years ago now called Money for Nothing. And literally a quote from that documentary was one of the Fed officials said, I think verbatim, the boom is worth the bust. You know, almost as if an admission that we know that these policies are going to create an artificial boom that will eventually bust, but we're calculating that it's worth it. You know, under what demented world that is the best we can do, I don't know.
Right. And that's the kind of logic that reigns in the boom, but rings really hollow during the bust. All right. Well, with that said, folks watching, if you have enjoyed this interview with Steve Hanke, please do two things. Hit the like button and then subscribe to this channel if you haven't already by clicking the subscribe button below, as well as that little bell icon right next to it. I know those sound like two really small things to do, but they help us get these videos distributed more widely, and that then helps us bring on even bigger guest names in the future. All right, and if you want to see who we're going to have on this program coming up, or contribute your voice into who you'd like to see us interview, just follow me on Twitter at Menlo Bear. I read all the user comments there. And then lastly, if you are trying to make sense of this crazy market that we are, having to hack our way through here, in the darkness, it feels like, and you would like the counsel of a financial advisor who, sees the risks that Steve talks about and takes them into account and putting together their portfolio strategy. John and Mike and the team at New Harbor, they are happy to talk with you. They offer a free, no strings attached, no commitment consultation, strictly as a public service to folks. If you think you might want to talk to them and have one of those consultations, just stick around at the end of the video here. It's coming up in a couple seconds. We tell you how to do that, and it only takes you a few seconds to schedule that. All right, John and Mike, we are in, the doldrums of August, but things are beginning to look pretty, rickety out there. So no matter what happens next, we will continue tracking it here on this program week after week. And no matter what happens in the next 7 days, I'll be here in a week to talk about it with you guys. Thanks so much for joining this week.
Thank you, Adam.
Thank you, Adam. We'll see you next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.